Okay, so today I want to talk to you about the economic factors or economic drivers of investor search behavior in financial information markets. And this is important because financial markets are highly information driven, and in a competitive market such as the financial information market, consumers of information can, by comparing the products, get a better idea who's offering better pricing, or who's offering better features, or who's offering better coverage. And then by comparing the financial information providers, they can choose to focus all of their attention to one of the providers, or maybe they can use simultaneously all of the providers based on, for instance, their income or their risk appetite. From the news media, we know that besides our intuition, we know that there are many players in the market. We have the major players, Bloomberg and Refinitiv. We have small players like FactSet and Capital IQ. Today we have also Coagent, which I like a lot to search for finance data. And the market size of Bloomberg, for instance, was around 33%. So we have kind of an idea of the market shares in the financial information market. And finally, we have, of course, as in any other econometric model, something that we did not observe. I'm modeling this specifically as a type 1 extreme value function that is very convenient because it maps the whole model to a logic model, that it makes the model very tractable, and it scales well if you want to incorporate many more parameters, or a lot of data, it scales well to that. I have a question from the National Financial Capability Study in the United States that asks how willing you are to take risks. Also, the last question would be that thing that says more than $100 or more than $102 is a question on financial literacy. So it's a basic question of interest rates. So if you had $100 and you had this level of interest rates, how much money would you have in a month or in a year? Interestingly, not everyone responds that well. So there's many people that report to have securities or derivatives inclusive, but they do not. There's a percentage of people that do not respond to this question well. So I wanted to know more or less what's the influence of financial literacy on the information demand and financial markets. So if I count the number of IP addresses, of different IP addresses that have daily searches in Edgar, I can have an idea of the different number of people or institutions that in average access information. Now, from the Bloomberg index and from the Edgar records, I can have the number of different stocks that have been looked for every quarter in each of the information providers. If I multiply this and divide it by the potential searches, then I get the market share, what we would call it the observed market share. We map that to a logic model with some distributions that can be easily solved by numerical methods, and by making the distance between the function describing the market shares and the observed market shares, we can recover the parameters. The results of doing this would be that the overall effect of the price of the service is negative to information acquisition, then the overall effect of the perceived future returns would be positive with respect to information acquisition. But now if we interact that with investor level preferences, we would say that the marginal valuation of investors with respect to perceived returns decreases with the income level. For these others variables that I thought maybe I could find something interesting, like literacy or sex, there's nothing there. Market shares can be calculated like in many forms. Maybe you have your own way of thinking, well, I would have done that. That's That's correct. So I did it in another way. I took the 33% of Bloomberg reported market share, and I compared that with the number of different IP addresses I can see from Edgar, and I calculated that it was more or less, Bloomberg market size was more or less 1.2 times that of Edgar. So I just make that multiplication quarter by quarter, and by using that market shares and the corresponding upside option, I get these results. Price is still, the net effect of the prices is still negative. The effect of the overall effect of the perceived future stock returns is positive, and still the interaction with individual or demographic investor characteristics is negative, that meaning that the marginal valuation of 1 percentage point in perceived future stock return diminishes with the level of income. So what we have here is that so far, the first is that fees are in line with the standard economic intuition of downward sloping demand curves. That should be fine for me, because otherwise I would say, okay, something is not working there. And also it looks like investors really put some attention on those providers that are perceived like providing a better insights about the firm that lead you to higher expected returns. Now, limitations and discussions. Well, ideally, I would like to measure market shares from direct observation of searches, and ideally, I would like to have every investor telling me how much they paid for the bit of information. There's something really close to that because Bloomberg has something that is called identity objects. So they record the time of accession of each of the customers. They record the functionalities that have been accessed. Unfortunately, for the outsiders, that information is not accessible. That's information that only the marketing people of Bloomberg have, but it exists. So ideally, I would like to come with that. I should have included some measure of the price of technology, because it is important even for the free access providers. One proxy would be, for instance, including the prices of disk drives. So that's a good idea. And when the model is well calibrated, we could respond to really important counterfactual questions that are important for both practitioners and academics. For practitioners, the question is, how would you measure demand? How the investor characteristics are affecting my business? But also for academics, it would be, okay, if a fee-based provider would exit the market, what would happen with all the searches? Would they all migrate to Edgar, for instance? They would all migrate to Yahoo, that is free? Or maybe there are searches or information acquisition that is lost. That is measuring welfare effects of companies exiting the market, right? And here's my email if you want to write me about it, if you have any idea, if you need the data, I can give it to you. Maybe not Bloomberg's data because Bloomberg doesn't allow me to share the data, but if you need something else, I can send you whatever you're interested in, and thank you. If there are questions, of course, we are discussing them. Thanks.